All right, so in this video, I'm going to talk a little bit about credit scores. So credit scores, that's distinct from credit reports. Credit reports are big detailed reports of all of your credit history and the different loans you've had and the balances relative to the amount that you could borrow. Things like that, and also your payment history, and if you've ever been late, and if you've ever gone bankrupt during the established period, things like that, basically. So that's basically what a credit report is going to show. A credit score is a numerical representation of credit worthiness. So it basically takes all that information, kind of boils it all down to a number. So to use sort of an analogy overall, a credit report would be like looking at detailed, granular information about how well you did on every assignment and every question throughout a course. So it shows, every question you got wrong and all the grades you got on the different assignments and all that. That's more like what a credit report would be, showing all kinds of detailed information. The credit score would be kind of more like your overall percentage grade at the end of the course, where it's just, here's the number, okay? That summarizes all of that other stuff, but it doesn't show you all the other detail. It just shows you here's the number. So typically, in order to arrive at a credit score, what the entities with creating credit scores are going to do is they're going to take generally 4 or more variables with different weightings and different ways of getting information into some kind of numerical form. And basically, they're going to take those variables with different weightings and generally different proprietary scoring systems, and they're going to kind of boil all this down into that number. So that's kind of the idea. So it basically, they take all of that information that's in a report, well, whether you've been late, and how late, and what your utilization looks like, so how much you're borrowing relative to what's available, and whether you've gone bankrupt. It takes all of that detailed information and then basically compresses it down, transforms it through some kind of weighting and proprietary formula to turn it into a numerical representation of your creditworthiness. Now, many scores are linked to FICO software. FICO stands for Fair Isaacs Corporation. So Fair Isaacs Corporation, basically, they have software where they basically take all that kind of information and essentially translate it into scores. So a lot of scores are linked to that in some way. So I'm going to linger on that. Other scores may differ a little bit in kind of how they are constructed, but the idea is similar, although the weightings of the different factors could be a bit different. But the idea is relatively similar. So for FICO score, technically the way that the composition of the score, the weightings of the different factors can vary for different population groups depending upon whether you have much of a credit history or don't have much of a credit history and so forth. So the percentages I'm going to list are more like averages for the general population. So generally speaking, this is kind of approximately what is producing your score. And basically, the first category is payment history. And so for the standard FICO score, about 35% of your FICO score comes from payment history. So basically, think you've been paying on time, you've never late, you've been paying the required amount, and basically they're going to go back up to 7 years for this. So a long history of paying on time, never being late, things like that. So basically, if you're doing those things where you never miss a payment, you're never late, over the 7-year period here, then basically you're gonna have a really good looking payment history. And that accounts for about 35% of the score you wind up with. The next 30% is looking at the amounts that you owe, and that's looking at basically kind of debt burden and essentially what they call utilization. So in other words, how much do you owe relative to sort of what's available? So there are kind of some multiple extremes here. So it doesn't look necessarily great, contrary to some intuition. It doesn't look great if you have a lot of credit available and you owe absolutely nothing. And the reason for that is if you owe absolutely nothing, even though you have all this credit available, then people kind of start to wonder, at least the credit agencies kind of start to wonder, well, do you actually know how to handle debt? I mean, you've got a lot of credit that's available, but have you actually shown how to do anything with it? Can you actually make payments? So if it's a little bit too low, then they might not know quite what to do with it. So if you have no debt at all, but a lot of credit available, then that may not look the best. On the other hand, if you have an excessive level of debt available, in other words, you borrowed like 99% of the dollars that lenders are willing to lend you, that looks bad. And that kind of makes sense because if you've borrowed almost every dollar that somebody's willing to lend you, people are going to start thinking that you're more likely to go bankrupt, which is obviously not good for a lender. So basically, what you don't want to have is a situation where you're overutilizing the credit that's available. So you want to keep that kind of moderate and not have too excessive of an amount of borrowing relative to what's available. So that also would mean like on credit cards and things like that. If you have a maximum credit card balance of $5,000 in a given month, you don't want to rack up $4,500 of it. It doesn't look good, right? So you want to make sure that you never have a balance that's too high relative to the credit that's available, basically. And that accounts for 30%. So basically, up at this point, about 65% of your credit score is related to paying on time, all the time, every time, never being late, and always paying what's required. And then basically just not overutilizing debt. And so using an appropriate amount of debt, not too high, not too, not none at all, but basically just making sure that you're not using too much and maxing stuff out. If you're maxing out your credit cards and things, that's going to look really bad. The next 15% length of credit history. So average age of credit accounts is kind of what they're getting at here. So if you have a credit card that you've had for 5 years, probably you want to keep it open because you've got nice history there. And you kind of built up the length of the history there. And so that looks good that you have this history. So basically you want to have a length of history available there. Then the next 10% is the types of credit used. So they basically credit bureaus and lenders are looking at, do you have the ability to manage different kinds of debt? If you've only ever been able to handle one type of debt, then that doesn't look as good. But if you've been able to successfully make your payments on a student loan and a home loan, and kept your credit cards making those payments in a timely manner and so forth, it looks like you know how to handle it. And so that basically looks good. On the other hand, if you've only ever had one type of loan, then it does raise some questions of do you actually have the ability to budget and plan accordingly to handle multiple kinds of debt or not? The next 10% or the final 10% is basically new credit. And this is looking at how many applications in a short period are being made. And so if you have hard inquiries where these are inquiries by a prospective lender, that's going to appear for 2 years. But they only count for 1 year under the FICO system. So they're going to show up as there were hard inquiries by lenders. So it looks like it's tracking your history of trying to borrow money, basically. And significantly, if you have the same loan type of hard inquiries, in other words, if you go out and you're trying to get loans, you're shopping for a mortgage at multiple different banks and financial institutions all in kind of the same period, that may wind up being grouped together as, okay, this is sort of one big hard inquiry. You're just trying to figure out where to borrow the money. You're not like trying to borrow to buy 6 houses. You're approaching 6 lenders to try to find the best deal to buy 1 house, right? But if you are out there and in a short span of time, you have a hard inquiry for a car loan, a hard inquiry for a home loan, and then you're trying to apply for a whole bunch more credit cards, and this just doesn't look good. And so, that's going to look much worse in that kind of scenario. So the FICO score is going to range from a low of 300 to a high of 850. And so obviously the higher you can get, the better. And there are some different custom credit scores where they may customize it for certain purposes a little bit. So, the calculation may be a little bit different. In some cases, you could have some other, pieces of information that are incorporated and things like that. Now, in 2015, they actually did a pilot where they were looking at some alternate data to try to incorporate that to see if they could use other information to get to a FICO score. And in 2019, they introduced the Ultra FICO, which basically allows linking bank accounts to your credit history. So you can actually show the progression of your bank account and kind of match that in your financial progress and use that to hopefully positively impact your credit score to show that that you've been making good financial progress, even if it doesn't show up on your credit arrangements because you just didn't borrow a lot of money, for instance. Then that could show up. And that also brings up the under FICO score 10 and 10T. So they've been making revisions over time. Basically, that includes trended data. So you're going to show trends in the data, and if things are trending in a better direction, then that would look good. If things are trending in a worse direction, that would obviously be bad. let me kind of at this point kind of talk about some other scores and things like that. So there's something called a Vantage score that was launched in 2006, and that was a joint venture between the different credit bureaus. And so for that, it applied more weight on the last 2 years of history, but that's another score that the credit bureaus tried to come up with. And basically, ultimately, the key reason we care about this is that better scores lead to lower borrowing costs and significant savings. So if you could drop your interest rate on a mortgage from, let's say, 8% to 7%, from having 8% with, not great credit to 7%, you got much better credit. That could save you possibly tens of thousands of dollars over a standard 30-year mortgage period. So it could save you significant amounts of money. And so that's why you'd care about having a good score. Also, interestingly, there are basically some credit scores that are tailored for the insurance industry. And the insurance industry, in some cases, will look at these credit scores and these scores that are tailored for the insurance industry. So they're actually called insurance scores. And the reason for that is insurance industries have determined and realized that lower scores are actually linked to the probability of an insurance claim. So people with worse credit scores, statistically speaking, have a higher probability of making a claim on their insurance. And so if you're an insurance company, well, then that means the higher probability they're going to have to pay out, and therefore they charge more for the insurance in that case. So hopefully this summarizes a little bit about credit scores, and hopefully it helps. Thank you so much for watching, and have a great day.